Okay, so if this is where the seller now is and this is where the buyer is, this must be fair value, right? So you'll hear us talking about where fair value is. It's the mid price between the buyer and the seller. It's the mid price between the buyer and the seller. So we see the liquidity pulling away, and this becomes where the dealer's bracket is. This becomes where the dealers are now camping out in terms of trade opportunities. So when the data comes out, you get what is a simple, straightforward volatility expansion, because what happens prior to that is the price will trade like this, usually. Usually the price trades like, not always, but the price basically trades usually like that. And then the data comes out and something happens. Sometimes you'll get a spike like that and then it'll do this. Sometimes you'll get a spike like that and then it'll do that. There's all sorts of things that can happen at that stage. But one of the key aspects is what drives the algorithms. The algos these days are based around words. Interestingly enough, if you've ever read any of the books on algorithms, you'll already know this anyway, but the algorithms are based around words on releases. So the first thing that the algorithm does is, as soon as an electronic release is made, the algorithm reads what the electronic release is and does a trade instantly. So way faster than you can even read it, press a button with the lag you've got on your computers. The algorithms, the banks have already got that trade on way before you've even blinked, basically. So that's assuming they didn't have inside information about what the number was going to be, of course. So we've got the algo driver. So what did they look at first? They look at the headline stocks number. So what they're going to look at first is the headline stocks number for crude oil. Okay, that's the main Cushing number itself. So they look for the headline stocks. And the first move will come from that headline number. Then they'll look at the gasoline. They'll look at the gasoline numbers, and that'll be the second move. So they'll be looking to see whether the headline is bullish for oil, and the secondary move is bullish for oil, in which case it's going to drive probably through the top line bracket. If the headline's bullish for oil, but the detail is bearish for oil, the spike will go higher, and I'll sell into that bracket area. So obviously these are the combinations that we get. We get the bullish move first and then the bearish move second. We get the bullish move first and the bullish move second. We get the bearish move first and then the bullish move second. And then we get the bearish move first and the bearish move second. These are the only four real combinations we can get, unless of course it's just simply neutral. It's right in line with expectations. So obviously if we start thinking about what happens in each of these four scenarios, we get a bullish headline. So obviously what's going to happen is the price spikes in the bullish headline, and it all depends upon degrees of bullishness, and then we get the bearish move coming in. Bullish, bullish, you'll get the move going straight up. Bearish, bullish, you'll get the move down, followed by the reversal. And then bearish, bearish, of course, you'll just get the move going straight down. So obviously this is why we want to know where the dealer's levels are, so that we can start expecting and seeing where these possible turning points may be located in terms of the oil inventory release. So that's how you trade the oil inventories. Sometimes we get a crystal clear trade opportunity. Sometimes we simply don't get any chance because it's, say, bearish, bearish. What would bearish, bearish on oil be? Well, everything about oil is built around two words plus one forecast. The two words, Paul's absolutely right, the two words that you're always looking for is build or draw. It's not a build and a draw, but across one product, of course, it's a build or a draw across one product. And the other thing is against forecast, positive or negative. Because it doesn't matter if it builds. It doesn't matter if it builds on last week. It depends how much it builds on last week, right? So if they're forecasting a very big build and it's a very small build, you know what's going to happen. There's going to be a difference in the way that the oil price responds, right? So which one's which? What does a build do to oil prices? What does a big build do to oil prices? Anybody? Oil prices drop, and a draw, of course, oil prices rally. Why is that the case? Very simple, because it's about inventory. If you've got a massive inventory of stock in any product, most of the time the shop will do a what? If you're sitting with massive inventory in the back rooms of your shop, it's dead money, right? If you're sitting with a huge inventory in the back room of your shop, you're going to say, let's get it on sale, guys. Let's get this converted into some cash here. So obviously what's going to happen is you're going to put up a big sale and you're going to sell your stuff, okay? So prices drop. Prices drop. If you've got a big build, prices drop. If you've got a big drop in inventory, prices rally. Yeah? Straightforward. Everybody happy with that? So that's what we'll look at. So what will happen is, as we come into the oil charts themselves, usually about 10 minutes before the inventory release, you'll see that the liquidity vanishes to almost zero, literally almost zero. That's why we get the spike at the news. That's why people say, oh, well, you know, you get some of these buffoons in the retail space. Yeah, I got 50 contracts 1 second after the inventory release, and I made $1 billion on the trade. What a bunch of nutters, right? Absolute twats. There isn't 50 liquidity at the second that the inventory release responds. There's literally next to no liquidity available for anybody at the inventory release. So it doesn't happen. It simply doesn't happen. So it's just lies, lies, more lies. But we can obviously see that as it happens, guys. You'll see that inventory dropping. And as inventory drops, we all know what that means. Inventory drops means volatility expands, correct? If the inventory of supply and demand drops, so inventory drops, in other words, there is nobody buying or selling, that means there's going to be a volatility explosion. Anytime liquidity drops, volatility rises. Anytime liquidity rises, volatility drops. Does everybody agree with that as a simple, basic statement? And you may say, why is that useful? Because when I see a volatility collapse, should I not get ready for an RGL trade? What do you think? If you saw a volatility collapse, would you get ready for an RGL trade, yes or no? Theo says yes. David, yes. Okay, nice. Okay, let me show you a liquidity trade then that did exactly that just a short while ago. Do you know what I'm talking about, Reeve? I know Reeve pays attention to this. Do you know what I'm talking about, Reeve? This is where he says, no idea, mate. No idea. What the hell are you talking about? No? Anyone? Okay. So, at the bottom of this chart, you'll see that this is bid offer liquidity. Okay? This is bid offer liquidity. Offers, bids, offers, bids, offers, bids, just chopping backwards and forwards. Okay, nothing to see here at the present moment, right? I'm not talking about whether there's more bids or offers. I'm just talking about the actual bid offer liquidity. You can see the number of contracts that are available on the right-hand side of the charts here. What do you notice on the right-hand side here? What are you actually starting to notice on the right-hand side here? You're starting to notice a reasonable drop-off in liquidity, aren't you? Total liquidity, bids and offers. You're starting to notice a reasonable drop-off in liquidity from 1,400 contracts down to around about 900 contracts. It's 500 contracts lower, but it gets better than that. You also start to notice that there is a voltic taking place at 149.20s. And you say to yourself, that's interesting. I think this could be an RGL. And let's see what happens on the next candle, guys. Let's see what happens on the next candle. Take a look for yourself. Do you see what happened on the actual next candle? Anyone? The liquidity went from 1,400 contracts on the inside market to just 300 contracts. 300! So this is going to be a volatility expansion here, isn't it? There's going to be a drive. But this doesn't tell us which direction, does it? It doesn't tell us which direction the drive is going to be. It tells us that there's going to be a drive. So this becomes effectively an RGL type trade, doesn't it? So we go along to the next candle, and what do we see? We see volume, volume, Voltics, volume, Voltics, volume, Voltics coming in. We start to see all that volume coming in. We start to say, wait a second, there it is. 19 sell side, 22 buy side, 23 buy side. What do you think? 19 sell side, 22 buy side, yeah? You're starting to see that idea of what happens when we come into news releases, data releases, right? So this is what happens on oil. This is a really good example because this is what's going to happen on oil. Do you understand that? So the volatility is vanishing on the inside market. Well, that's what we showed you, isn't it, in the drawing? In the inside market, which is really tight liquidity at the beginning of our drawing, the volatility got less and less and less, didn't it? Because the volatility was getting wider. The volatility, total volatility, did what during this period? Total volatility went like that, didn't it, on oil? Total liquidity on oil went like that. So obviously, as the total liquidity goes down, the volatility is about to explode. So you start watching that as a storyline, don't you? So you've now got an area around the volatility expansion. Bonds are good for this, especially things that aren't particularly dramatic bond movers. Things like CPI numbers, you won't get the opportunity, but things like durable goods or home sales or any of the kind of lesser numbers are going to be very good to look for these opportunities. What happened next? You see what happened? The price broke sell side. You were able to sell some trade at 19s, as we suggested, 19s short. You were able to sell some trade at 19s, take advantage of the short trade, took down a nice little bit of profit, came up, maybe scratched it +1. You sell it again, maybe at 18s this time. You sell it again, maybe at 18s. You're back in again for the volatility expansion, and the trade continued to sell off beautifully. We've just went from 19s down to zeros. $500 in profits. Is that not outstanding? Sure. It's exactly what we're looking for, isn't it? Exactly what we're looking for. And you can see that it just gave us a beautiful situation evolving in this area. And obviously at that stage, you can see that the liquidity came in far too hard. We started to see a blue R, which is a bottom edge, isn't it? That blue R suggests that there's a bottom edge forming in here. We know that that's a bottom edge. We know that there's going to be a bottom edge. You can see that there was one attempt at taking the price down and sweeping the stops. And obviously that was a great opportunity for us to buy into bonds at that stage. But that's a different trade, and that buy went beautifully away from that bottom edge price. Yeah. So we can see just how good it was simply from a volatility perspective. Fantastic trade with a brilliant outcome, $600 eventually, just by recognizing the volatility collapsing into a puddle here, knowing that there is going to be a very substantial volatility expansion from that point. As liquidity collapses, usually volatility collapses into zero as well because nobody's dealing, nobody's trading. And then everybody's trying to get a read. Everybody's trying to get a read at the same time. And that's why we get expansion from prices. So they make a read, they all get the same read, roughly, or give or take a few traders. They get roughly the same read, and now they're all piling in to be short or long the market from that point. And we get this brilliant volatility expansion as the price drops. So that's what you'll see in oil, guys. That's what you'll see in oil, except you won't see the buyers and sellers congregating around that, that fair value price for 2 or 3 minutes after the release. It's gone at the release, guys. It's gone. It'll be finished at that stage. Finished at that stage. So again, another very, very important little piece of information, very valuable to recognize it, very valuable to trade it. Those little volatility expansions, absolute gold dust for anybody that understands that little concept. If anybody's ever traded news, you'll know exactly what I'm talking about.